Hi, this is Tim Maurer and Drew Tignanelli from the Financial Consulate. This is our December 2nd client update. And Drew, it's been a pretty crazy year this year, and that's a little bit of an understatement. But from where the year started to where it finished, crazy stuff.
At this point in time, we still have enough time for more crazy things to happen. And I'm afraid that there could be some crazy things that could happen before the end of the year.
Yeah, so before I ask you a couple specific questions, do you want to give me a broad thought on where we started to where we've come this year?
Well, still at the beginning of this year, we were still going through what's called systemic risk. In other words, the economic system could have literally collapsed to zero.
Right.
And come March, they pretty much had plugged the little boy had his fingers in the dike.
Right.
And he had
lots of fingers.
10 fingers in the
Called
dike.
some friends in.
Such that you have Fannie Mae as a zombie company, Freddie Mac is a zombie company, Citigroup could still be, AIG. There's a lot of major financial institutions in the United States that are just zombie companies. In other words, they're dead.
Right.
They're not really alive and vital flourishing companies. But the government is just kind of keeping them afloat, which is anytime you have that artificial from the free market, you got problems that can persist long term. But anyway, so we had that. That's been resolved. We have such low interest rates now. Banks have been able to fill their coffers up with cash that they're able to deal with their loan losses that they have. That the banks are getting healthier now than they've been in the past, and that's a good thing. And so systemic risk is gone, low interest rates, people are getting 0% on money markets that they're going at looking for alternative investments to get a higher yield. And when they do that, they bring risk. They bring risk of the stock market, risk of the bond market, etc. And so people are out there looking for alternatives. And that's what's driving the markets for the most part right now.
Sure. Now, among the personal financial planning things that we do for clients, one of the primary, especially in 2008 and 2009, has been investing. And we approach investing from almost like a triune type of perspective. We look at three specific things: technical factors and the patterns that the market goes through over time, fundamental investing factors, valuation of markets, and also then global macroeconomics. Would you just give me a bullet point on each of those as how you see things and investing through that lens today?
Right. We call it risk opportunity investing, and basically we don't believe that just because an investment is volatile, that it makes it risky.
Okay.
So in other words, just because the emerging markets can go up a lot or down a lot, don't make them risky.
Okay.
In my opinion, risk is a matter of what price did I pay? Did I pay when the market was way up?
Sure.
Or did I pay when the market was way down? And when I pay when it's way down, the risk is washed out of that equation. So that's risk opportunity, and the way we determine the risk-reward ratio when we're making an investment selection, be it a fund or a stock or an ETF, is we look at these three things. Technical is looking at patterns, the way markets move, secular bull market, secular bear market, cyclical bears and bulls, patterns and so forth. And they do repeat.
Long periods of time.
Long
15,
periods of time,
20
short
years.
periods of time.
Sure.
And they do repeat, and they do give signals of the market. They're not perfect, but they do give helpful hints of the rhyme to understand the rhyme of the market. So technically right now the market is healthy.
Okay.
It's trying to go higher, the momentum is higher, the patterns of the market are healthy looking right now, but looking at past patterns, it wouldn't be uncommon for this market to unravel sometime within the next a year.
Good to know.
Technically. So right now the momentum is positive.
Okay.
And no reason to believe it's going to slow up. Fundamentally, looking at valuations, you're looking at price to earnings ratios, people call PE ratios. In a bad bear market, typically a market will get down into single-digit PE ratios, 5, 6, 7 PE ratio on the Dow or on the S&P 500. This market has never gotten much below 12. And right now, I think it's at 22. So,
and especially considering the systemic risk you were talking about that existed at the beginning of the year, you would have expected it to wash out a good bit more.
When you're talking about the worst economic downturn since the Great Depression,
yeah.
you would have expected this market to get washed out a lot more.
Right.
And the reason it's not is because you do have such an overwhelming amount of the population that participates in the market. In the past, in the 70s bear market or the 30s bear markets, you didn't have that many people participating in the market. It's a much more select group of people. Today, everybody's got a mutual fund and a 401k
sure.
or an IRA or something like that. You have a much broader section of the U.S. economy participating. And I believe that at the end of this bear market, you will scare the heck out of enough of those people that they will give up on stocks for good.
Sure.
And hopefully our clients never will, because we will be able to guide them through. I can't guarantee that we're going to guide them through, but I feel very confident that we have the wisdom, the knowledge, and the ability to direct that.
Sure.
And right now, from a macroeconomic point of view, interest rates are low, the dollar is declining. Now, as long as the dollar doesn't collapse, you know, you don't have just collapses.
Sure.
Right now, it's just declining. Nice, even, steady decline. As long as it continues to do that, that's actually bullish for the U.S. stock market.
Interesting.
And, you know, interest rates at zero. Nobody wants to leave their money sitting around in money markets and things.
Put it into somewhere I can make more money.
That's the idea. And, you know, people are being able to borrow in the bond market because people are looking for higher rates of return.
Right.
So money's going back into the bond market. People can borrow in the bond markets and so forth. So from a macroeconomic point of view, from that perspective, it's positive. But from a negative perspective, small business owners are frightened. They're still laying people off. They're not hiring anyone. And consumers in America are pretty much tapped out. They're going to still spend, but you got 10% of your population's not spending anything hardly at all.
Sure, maybe even closer to 15 or so when you take in all the factors of unemployment.
If you take in all the factors, probably a significant portion. And I'm afraid that this Christmas could disappoint, and if it disappoints too much, you could really have a market that takes pause.
So we talked about the technical, the market valuation, and the fundamental approach, the macroeconomic. Do you want to give us a final word on transitioning from 2009 into 2010?
Well, we're concerned. We're not afraid, but we're concerned. And that's why we've got 1 foot in and 1 foot out. And the foot that we do have in the equity markets is, even for our most aggressive young people, we're down to less than 50% invested in equities. For our most conservative client, we're down to about 30% invested in equities. And most of that exposure is in Asia, where we are very optimistic about what it offers. And a lot of the equity exposure we have is in commodities or high-yielding, very conservative dividend-paying companies.
Sure.
Like Kraft Foods, like Campbell's Soup, like Becton Dickinson. Berkshire Hathaway doesn't pay a dividend, but there's a great cash flow that's generated by that business. Those are the kind of conservative investments we're using right now because of our concern. Not overly optimistic and certainly not overly pessimistic. Somewhere 1 foot in, 1 foot out.
Well, 1 foot in, 1 foot in, out, but right now we've got 13 employees serving our clients well, Drew, so that's 26 feet. But either way, I'm willing to put up with that minor discrepancy.
Attempted humor, I guess that we would call that.
Well, thank you. I appreciate all of your wisdom. Thank you very much, and we hope you have a great Christmas, a happy Hanukkah, and a fantastic New Year.
Yes, and we do just want to say that our job is to lessen the worry and burden of money management, so enjoy the holidays. God bless.